So I'm gonna read off ChatGPT. I trade stocks, and this is the answer it gave me for what do prop firms or big traders do to win against retail traders like myself who are losing money to them. And here are some things that they do. To begin with, there is, a perception that like big companies take advantage of retail traders that are not in the know-how. And we retail traders trade emotionally. So let's start. All right, prop firms. How prop firms operate? Prop firms operate by providing the traders with capital in exchange for a split of the profits. These firms often employ advanced tools, strategies, and data that retail traders don't have access to, giving them an edge in the market. They focus on liquidity zones and manipulation of price movement, often taking advantage of retail traders' predictable behavior. For example, their stop losses and emotional trades. I agree with that. They have all the tools necessary and they will invest in all the tools necessary to always be ahead of retail traders like myself. Let's continue. What is the edge over retail traders? Sophistication. Prop firms use algorithms, high frequency trading, HFT, and in depth market analysis to identify opportunities retail traders might miss. Risk management. They have strict risk controls, whereas many retail traders take large, riskier bets, often without a clear strategy. I completely agree. If we retail traders, sure, we could have the tools, but most importantly, have better risk management. Number two, the flow of money in the market. The market operates in a zero-sum game in many ways, especially in short-term trading, meaning one trader profits is another's loss. Retail traders, many small accounts, retail traders often lose money due to emotional decision making, lack of discipline, or being outmatched by larger, more skilled players. Institutional traders, few but large accounts. Institutions, hedge funds, and large traders with better resources exploit inefficiencies, often feeding off retail losses. 3. Market manipulation. Large players, institutions, hedge funds, or even prop firms can influence price movements. Interesting. This is with liquidity hunting. Institutions may push prices into zones where they know retail traders have stop loss orders or emotional exits, forcing them to sell or buy at a loss. Fakeouts. Market makers may create false price movements to trap retail traders, only to reverse the trend and profit from their losses. 4. Why retail traders lose. Lack of experience. Many retail traders lack the training, discipline, and strategy needed to succeed. Over leveraging. Retail traders often use high leverage, which magnifies losses. Chasing moves. Retail traders tend to jump on trends too late, buying at the top or selling at the bottom. Emotional trading. Fear, greed, and impatience often lead to poor decisions. 5. Is it always this way? Not necessarily. Retail traders can win by thinking like institutions, understanding how big players operate, aligning their trades with these movements. Risk management, limiting losses and preserving capital to stay in the game. Education and discipline, developing strategies that take advantage of inefficiencies rather than reacting emotionally. In summary, the markets are structured in such a way that small number of big players, institutions, hedge funds, and prop firms with substantial resources often extract money from larger groups of retail traders. However, retail traders can succeed by improving their strategies, focusing on risk management, and learning how to anticipate institutional moves rather than being caught buy them. So after reading this makes perfect sense. It summarizes everything that's going on to you and me as retail traders and how we lose money. So our job is to anticipate into institutional moves. Now, just learn, how are you losing? What are they doing to manipulate the chart so that you lose? They trap you. And this you only learn by getting involved in the market and losing and learning how you're losing, learning by experience. And I would, for me, I put in a little bit of money to learn and lose a little bit, but I will learn a lot from that loss if I journal, if I reflect, if I think about entries, exits, why I got in, what contract I chose, why did I wait, how long did I wait. Everything you have to analyze so that this is information you're going to use, because the prop firms and the big guys use it so that they learn who they're going to take their money, who they're going to take money from. So in essence, use ChatGPT to like improve your trading psychology and all that stuff. So see y'all later. Bye-bye.